deposit options, and what are they? Okay, so a lot of the stuff that you guys are going to be doing at the beginning is going to be low deposit options. And so one of the things I want to encourage you to talk to your clients about is trying to get to that 20% deposit. First home buyers, basically first home buyers. So anyone who's looking to purchase, there's two parts to every application, remember? Equity, servicing. Equity is, can they get to a 20% deposit, or what deposit do they have? Servicing is, what is their income to their outgoings ratio, and can they afford the lending that we want to put in place? A lot of the bank calculators are going to determine that anyway, but this is how we can work in with this. Okay, so deposit options. Now, typically we want them to have the 20% deposit, but if we can only get them to 10%, but they've only got, say, maybe 5%, which is important because a genuine 5% deposit is really important from the bank's perspective. They want to see that the client has at least contributed 5%. So in order to get them up to the 20% or even the 10%, because sometimes they'll be this close, and to help avoid low equity margins, sometimes we might want to get them just to that 20 or 10%, depending on what it is. So there's 4 options, okay? 4, let's call it parental or family assistance options that might be able to help. In the past, what I've found is that a lot of clients go, oh, I don't really want to have to bring in my family, I want to be able to do it on my own. And at which point I'm like, if I can get their help, man, like if you can get their help, it's going to help with pricing, it's going to help with those low deposit options, and it's going to help with low equity margins. It's going to help your approval. You'll have more banks available to you because you won't have to go to just their bank because you've got under 20. So at any point, see if you can get that family assistance, or encourage the client that if it's been offered, to take it. 4 options. Number 1, gift. Perfect. We love a gift. Now, a gift, we have the gift certificate, and there's got to be some very precise wordings. Now, with the gift, it typically means that it's yours. Take it. I'm not going to ask for it back. I'm not going to impose interest repayments, and I'm not going to register a hold on the property's title. It's a gift. It's yours. Have it. In some cases, that will be early inheritance. It could just be that mum and dad have been also saving in the background to help. If you've got a couple, it could be both parents, both respective parents who have got money that they're happy to help out with. So a gift is beautiful. It's great. A gift is going to help impact the equity to help you get to a higher deposit, so a higher deposit amount, lower LVR. The next option that some parents or family might offer is a loan. Now, a loan is not only going to help with the equity side, but it's going to negatively impact the servicing side. Now, if you've got a client who's got really good servicing, this may not be an issue. But if you've got a client who's just really tight on servicing and really tight on deposit, a loan may not be the best option. You'd also have to request documents that would show the interest rate in which that loan's going to apply, what the repayment's going to be, what the term is, basically how long do they have to repay their lending, and what's the repayment, because that repayment then has to flick into the servicing calculators, and that could blow the deal. Similar to a loan, but perhaps not with the impact to the servicing, is the third option, which is our deed of debt. These are my all-time favourite. Now, the reason for these, and this is where you can show a little bit of your professionalism as well, is that if you have a couple who come in and say her parents want to provide like a gift, but they also don't want it to be part of a matrimonial or partnership property, then a deed of debt is perfect. Similar to a gift, the deed of debt will have no interest component. It's not repayable on demand, and they won't also put a hold on the property like a caveat or a forgot what it's called, anything on the title. Deed of debt means that the parents or the family members saying, you can have this money for your home, but I want it back once you sell the house. Now, from a relationship property point of view, parents love these because it means that they have lent the money to the daughter, so that if they break up, it means that the partner doesn't get to have their clause in that money. It's actually the daughter's money, the daughter's parents' money, that has to be repaid first. So it means that mum and dad will get their money back, which means that they can then go ahead and deed that back to the daughter for the next house or for her own house. So relationship property, it helps to protect, but secondly, it means that the parents might actually need that back for tax purposes, as well as inheritance purposes, siblings, because if they give the deed of debt to one child, it means that they will have to do it to others, but it also means that if they give the deed of debt, they get that back. So they might need that for their retirement, for example. So relationship property protection, the parents not having to then gift the funds to be subject, if it's from a trust, any tax implications from that side of things. So deed of debt's my favourite because it means that the parents can say, here you go, it's yours. And also for the kids who go, oh, I don't really want to take anything from mum and dad, I want to do it on my own. It means that you're getting that in a way that it's been given but not given. So deed of debt's my favourite, and banks go, yeah, sweet. Deed of debt doesn't impact servicing, but it helps with the equity. My fourth option is a guarantor. Guarantors used to be a situation where you could have a certain amount of equity given from the parents' property, for example, that would help to bring the equity, the deposit position for the buyer, down to that 20% deposit, or up to that 20% deposit, down to 80% lending. It used to be what we would call a limited guarantee. So for example, mum and dad might have like their house and it's worth say $1 million, but they could give equity of say 200k to the kids, but the bank doesn't do that anymore. So now it's an unlimited guarantee. So it means that the kid's house, it's got the parents' house as equity, but it's fully integrated by the bank. And so that if anything was to go wrong with the kids and the kids paying their mortgage, and the way that I phrase this in my meetings is that if you guys don't pay your lending and if you gap it overseas, they're not going to sell your house first, they're going to take mum and dad's house first, and it's their house that's at the most risk. That's how I tend to preface it in the meetings. So unlimited guarantees, which means that mum and dad's house has got a lot more risk than it previously used to back in the day. And then you've also got, it also impacts the servicing side as well. So the servicing side means that you have to then get an application from mum and dad can go, I just want to give them some of the equity, but we need a full application so we can assess your ability to repay the kids' lending, because if the kids were to go overseas and not come back and leave you in the lurch, then you have to be able to demonstrate that as a parent you can afford to pay the kids' lending, all of the kids' lending. But let's just throw a spanner in the works, because if mum and dad are older, because they're going to be, right? They're going to be older than the kids. If they were, say, 60, then all of a sudden we get to the situation where you've got 60-year-old borrowers needing to now prove that they can borrow or repay that lending based on their age. So if they're 60 and they have got technically 5 years of work left, we have to be able to go to a bank that can use them as a guarantor, but also use them as a guarantor in such a way that it's not going to be cut off at age 65. It's going to be cut off at say age 70 or 75. So that therefore means that the kids loan, let's just call it 800k, now needs to be repaid. If the parents are 60, we can go to 75. That's a 15-year time that they've got to repay the lending. Can they afford to repay 800k on a 15-year loan term based on the parents' financial situation? Invariably, that's going to be a no. And you also have to get the application from parents so that you can put all of that together and send it with the bank. Do you know what? There's some cases where the guarantees work, and then there's other cases that it doesn't. A lot of the time it doesn't work. Back in the day, when I first started lending, guarantees were amazing. We could use them, they were happy. But now, because it's unlimited guarantees and we have to assess the parents' ability to service the lending, that they just don't seem to work as well. The guarantees don't affect the kids, the borrowers, servicing, but it can absolutely be impacted by the parent servicing, because normally they're older, they've got less time to work, and sometimes the guarantees are already from a retired parent who is already over age 65 but it's got a freehold property, and they're like, you can have it, like you can use the equity. Can't, it's not that easy. So those are my 4 options. So when you're talking to clients, you need to have some really good knowledge of the stuff here. Gift, it's not repayable, happy days, take it, leave it, whatever. Loan impacts the servicing, and you have to figure out, and you have to get a loan agreement drawn up. Deed of debt, my favorite, because it means that the parents can loan it to the kids, but they want it back. 4th option, guarantor, impacts parent servicing and can be a very tricky application to put together. And not all banks are going to want that, because not all banks from an age perspective will go up to age 75 for lending. Westpac does at this current point that I've done the video. So hopefully that helps. Parental help, 4 options. Parental family help, 4 options. So when you're explaining it to a first home buyer, sometimes they want to go away and talk to parents about that. Always explain that the deed of debt is always your favourite, and also when it comes to property relationship, and you can say this is really touchy because let's hope you guys never break up. But if you did break up, then the parents, that set of parents will then get their money back first, and then you guys can split whatever's left. Don't always just focus on the separation, because that can come across. You can kind of throw that in as a, and we find parents love it because they can give money to their child, but it's not going to get wrapped up in property relationships should you guys separate. Make sense? 4 options. Go get them.